The telecommunications market has been one of the most unloved by the market over the last few years. Despite a lot of cash flow, very high dividends, stocks like AT&T have not really gone much of anywhere. In fact, AT&T stock is down almost 50% since the end of 2020. But this is a stock that now has a dividend yield of 6.8% as I'm recording. Very solid business, very solid cash flows. So I want to get into what I like about AT&T right now, why I think the investment phase that they're exiting and the cash flow generation phase that they're going into right now is a really attractive time to buy a stock like AT&T, not only for the dividend, but for the long-term cash flow growth, which could mean paying down debt and just generally running a more efficient business. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And let's start with a couple of charts. And I think these give a good picture of where AT&T stands right now. This is some of AT&T's most important financials. The light blue column is the operating cash flow. You might remember in 2022 was when they spun off Time Warner. So that is going to be one of the reasons that cash flow dropped in that year. What I want to focus on is the last 4 quarters. And over the last 4 quarters, we have seen operating cash flow increase from $32 billion to over $37 billion. So more than a $5 billion increase. Now, these are trailing 12-month numbers. So over the last 12 months, that cash flow number has increased really sharply. And there are a few reasons for that. There's some efficiency, there are some price increases, but a big piece is that they are just trying to generate more cash from the business. Now, the other piece of this is how much they're investing in the future. How much they're investing in capital equipment is really the biggest expense that they're going to have as a business. You can see that for years, capital expenditures were about $15 billion per year. That jumped to nearly $20 billion for the year ended December 2022. But those capital expenditures are starting to slow down. We've seen that in the last 4 quarters, down over $3 billion on a trailing 12-month basis. So you have cash flow from operations going up, expenditures for capital expenditures going down. As a result, free cash flow, which is the orange column, is rising really sharply. $12.4 billion for 2022. In the last 12 months, nearly $20 billion. So those are a really strong sign that AT&T is exiting this investment phase and going into a cash generation phase. The other chart that I wanted to show gives some of the operating segment numbers. So this is the mobility subscribers. You can see that is growing steadily over time. Churn rate is relatively low. So that's something that you always want to see from a telecommunications company. And I do want to highlight the flip side of that, and that is that broadband is on a steady decline. So this is both broadband and fiber. I'm going to get to some of those fiber numbers in just a minute, but overall, that broadband connection number is starting to decline. So we're not seeing AT&T get customers on both the wireless side and the wireline side. So something to think about. But the growth that you really want to see is in those postpaid subscriber numbers. Now, here are a few of the other numbers that AT&T reports. The charts that I showed earlier have some of these looking a little bit further back, but you can see that those postpaid subscriber numbers are going up. Average revenue per user, or ARPU, is growing a little bit, not a lot, but that's something that I think that AT&T can really push on in the future. And mobility services revenue, this is really what you want to see grow because this is where the high margins are. They're not going to make a lot of money. In fact, most of the time they lose money on selling devices. So when you buy something like an iPhone at an AT&T store, they're really subsidizing that. So this is kind of a razor blade model. You want to be paying those monthly fees. So you want to see the growth in that segment. Fiber subscribers doing a little bit better than the non-fiber subscribers or the DSL or cable lines that you would have had in the past. And you can see those ARPU numbers are going up. So people are demanding more fiber. Be interesting to see how that trends in the future as we have more 5G fixed wireless, which is something that AT&T has not pushed into much so far, but has been very successful for companies like T-Mobile and Verizon. The other thing that you want to see at AT&T is them paying down debt. Now, this is read right to left. So the current numbers is right here, $126.7 billion in debt, down nearly $2 billion from the end of last year. You can see that right here. This is where we're starting these numbers on the right-hand column. So that is a positive trend. That's what you want to see, is debt going down. Like Verizon, I would like to see them be much more aggressive in paying down this debt. But you can see that when you're paying about $2 billion in dividends per quarter, you need to have that cash flow be in excess of $10, $12 billion per year to be able to pay both the dividend and pay down debt. I think we're moving towards that direction where they're going to be able to pay down debt and they're going to be able to keep that dividend yield high. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Like I said, the market has not really liked these telecommunications stocks, but I think there's a lot to like here. It's an oligopoly market. There are really only 3 players: T-Mobile, Verizon, and AT&T. The competition typically in oligopoly markets is going to be a little bit lower than it is when there's like 4 or 5 players. I think that's what we're starting to see, is that they've all invested in 5G. Now you're starting to see prices creep up, especially as interest rates go up. They're all kind of saying, hey, we need to generate cash flow to be able to pay down debt and pay our dividends. And so there's kind of like a truce between all of these companies. And that's something we're seeing over time, is those cash flows are increasing as capital expenditures are decreasing. I think that's going to continue. And for investors, we're getting a pretty good deal. As I'm recording, price to earnings multiple is 6.6. Dividend yield, like I said earlier, is 6.8%. So you're getting a great dividend yield, getting a great price to earnings multiple. If they're able to pay down debt and even pay down debt really aggressively over the next few years, I think AT&T is going to be in a great position. Wireless bills are not the kind of thing that people are going to stop paying. Even if we go into some sort of recession, we are, as a country, the US is reliant on our wireless services. And so I don't think this is something that is going to be replaced. It's just going to be a matter of, are these companies going to be able to make money, and is that cash flow going to increase? In the past, it has been a very difficult business because these companies are all competing against each other. And especially when there was 4 big players, you have one that's trying to compete with lower prices, another's trying to compete with better services. They're all fighting a battle and nobody's really making excess profits. I think that's going to change in the future. They're all offering basically the same services with 5G. And so now it's going to be a cash flow business, and everybody's going to have to make a return on their capital, especially with the debt levels that all 3 of these companies have. So that's what we're seeing with AT&T. That cash flow is increasing, the churn rate is low, and the upside is if a company like this is able to bundle some of these services together. That could be fiber and wireless along with streaming services, so basically replacing the cable bundle, or it could be 5G fixed wireless, which is basically 5G broadband coming into your home along with wireless services and streaming services. These are bundles we're starting to see more commonly. I think that could give a company like AT&T a really good position. So I think the trends are in AT&T's favor. Keep an eye on those cash flow numbers, both operating cash flow and free cash flow. If that continues to rise, I think this stock is going to recover. And in the meantime, investors are getting a 6.8% dividend yield and a great price to earnings multiple. So the downside risk is relatively low and the upside potential is very high for a stock like this. So what do you think about AT&T and its dividend attractiveness as an investment? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.